Inflation will not be the cause of the upcoming crash. Almost everyone has been expressing concern about this coming inflation over the past few months. Ray Dalio, Michael Burry, and Warren Buffett, even global consumers, have noticed an increase in prices for almost all goods and services. The majority of investors also think that inflation will keep rising significantly in the future. Cathie Wood, a usual contrarian, believes that the contrary will occur: deflation. According to Cathie, the world has been preparing for inflation, hence the true unforeseen event will actually be a deflationary disaster. In this video, Cathie will explain her reasoning for holding that view as well as how the evidence supports it. Cathie Wood began her work as an economist and can support her statements with decades of experience. We must therefore listen to Cathie beyond judgment in order to fully understand her viewpoint. Actually, in the early 1980s, Milton Friedman and Henry Kaufman, two well-known economists, believed that inflation would persist. However, Cathie Wood, a recent economist, believed that inflation was slowing down. Since Cathie was completely right, it is not expected that she is now bucking the trend with her big prediction. The money supply is the first indicator that inflation is slowing down. It has grown dramatically since the epidemic began in terms of the M2 money supply. Savings deposits, checks, cash, checkable deposits, money market funds, and certificates of deposit are all included in the U.S. money supply indicator known as M2. It comes as no surprise that M2 money has grown significantly given the growth in stimulus checks. However, Cathie Wood has seen a tendency indicating the rate of M2 money growth is rapidly slowing down, from 27% in April of this year to barely 17% in May. M2 money growth has slowed down. This slowdown in growth is probably the cause of the recent increase in bond prices. Bond yields and bond prices are inversely connected, and 10-year Treasury bond yields have been lowered to approximately 1.5% after peaking at 1.7% in March. Accordingly, the bond market has been advancing as yields are falling. If this occurs, we can be certain that the bond market is forecasting deflation rather than inflation.
The bond market could be rallying because of what I just mentioned about money growth. I don't think many economists have observed, I haven't seen it at least, that the money growth rate has been cut in half from that 27% to 13.8%. Maybe the bond market is focused on that.
Although it may appear that the Federal Reserve's false purchasing power is the reason for the bond market's recent uptrend, the Fed has been buying bonds for some months. Therefore, this factor is not new to the bond market. The Fed's purchasing power has not decreased throughout the period because it was still in place in March, even while the bond yield rose. The Fed actually intends to sell some of the corporate bonds and corporate bond ETFs that it bought during the epidemic. Cathie Wood, like every other economist, had anticipated a bond market sell-off following the strong inflation reports, but the opposite has happened.
But I will tell you, with the CPI reports that we have gotten, PPI as well, much higher than expected, I would have expected the bond market to continue to sell off and interest rates, therefore, to go up. Instead, since the end of March, the 10-year Treasury bond yield has dropped from 1.74 to 1.43, no matter how strong the economic data have been, how high the inflation numbers have been. And so the bond market is sniffing something out, I believe. Now, many will say, well, it's just quantitative easing. And I think quantitative easing was true at the beginning of this year and through March when we went from 0.9 to 1.74. So nothing's changed on that score, but the bond market is sniffing out something here.
Although Cathie Wood may seem ridiculous, she does believe that inflation will continue into the future. Prices rose from 1.6 year-over-year in February to 3.9 in May, according to the Personal Consumption Expenditures Price Index. However, Kathy believes that this inflation rate could rise all the way to 5%, and she predicts that long-term prices will decline even though inflation may increase in the coming months. The growth in oil prices is preparing the economy for deflation, and OPEC, the cartel of nations that control the world's oil supply, is determined to recover some of its losses by maintaining a strict oil supply. This may seem odd given that as oil costs have increased, more and more people are turning to electric vehicles. Sales of EVs have grown more than those of fossil fuel vehicles during the epidemic. This is partly due to rising gas prices as well as the assumption that EVs are better than gas-powered automobiles. If oil prices rise, more and more people will be encouraged to buy electric vehicles, which reduces the long-term demand for oil. The price for crude oil is now resting around $75 a barrel, which is very close to the previous high of $77. According to Kathy, oil would eventually cost between $3 and $12 per barrel. $12 per barrel would represent an 84% decrease from the current price. If these low prices become a reality, there would be a significant deflation.
One of the reasons is, of course, OPEC, and they have about 5 million spare barrels they could produce per day. They're not. They want to keep the oil price high enough so they can fund their budgets. But at some point here, they may end up killing demand. When they start seeing demand destruction because of pricing, I do think they'll start producing. And as you know, longer term, the combination of electric and autonomous electric vehicles, we think, is going to drive oil prices down. As I've said, now this is my point of view, we haven't done the research to get us here yet, but I think we could go down, back down to where oil prices landed after the cartel took over in the early 70s, and they went from, I think, $3 a barrel or $4 to $12 a barrel. Wouldn't be surprised ultimately to see us back there, especially as electric vehicles continue to take off, and they are starting to take significant share.
The buying power of the US dollar during the previous month is another indicator of deflation. The dollar has greatly increased, which contrasts strongly with concerns about dollar inflation because the dollar is really stronger relative to other currencies. This may be due to Biden's capital gains and business taxes coming in lower than predicted. Additionally, commodity prices have been falling recently. In particular, lumber prices have suddenly fallen, which Kathy Wood actually projected before the crash occurred. There are also a few other signals, such as copper and pork prices in China, as Kathy says.
Against, I think, the consensus expectation, the consensus short in terms of currencies was on the dollar at the beginning of this year. And the dollar is not going down. And that's also consistent with the bond yields coming down, surprisingly.
Consumer demand is the final factor. Real consumption falls by 0.4% month over month, with non-durable goods falling by 0.5% and durable goods falling by 4.3%. At the same time, services consumption only rises by 0.4%, which is not as much as the decline in goods consumption. Altogether, inflation might not be as significant of a problem as you think, as seen by the decline in commodity prices, goods demand, and the slowdown of increase in the money supply. There are additional critics on the other side of the argument, such as Ray Dalio's analysis of the bond bubble and Michael Burry's prediction of approaching hyperinflation.